Welcome to the deep dive. Today, we're diving into the world of automated trading systems, in retail investing. We're talking about those tools, often called EAs, expert advisors, that help traders trying to take some of the guesswork and maybe the emotion out of their strategies.
Exactly. And for this deep dive, our source is a document called Scalping versus Trend Following, Optimizing Your Trading Strategy with EAs.txt.
So, we're going to unpack two really popular strategies that these EAs often use, scalping and trend following.
Okay. So we'll explore exactly how these two kind of different approaches work. We'll look at their unique strengths and, yeah, also the potential challenges with each one, all based on the information we've got here. But here's where it gets really interesting. For me, we're also going to look at how these two seemingly opposite strategies might actually be combined.
Hmm.
you know, to aim for maybe even better results. That's right. And for you, our listener, if you're interested in getting a solid handle on this without getting too bogged down in like heavy jargon, this should be a really insightful look. A look at how these automated strategies try to, well, boost trading performance while also keeping an eye on risk.
Right, sounds good. Let's kick things off with scalping then. Now, this sounds like it involves some pretty quick moves. What's the core idea there?
Well, think of scalping as a really high-frequency strategy. Basically, the main goal is to capture very small profits from tiny price fluctuations in the market, and to do this repeatedly throughout the day, often holding trades for just minutes or sometimes even seconds.
Wow, seconds. That sounds incredibly fast. I mean, how can anyone or any system really make like consistent profits with moves that small?
Well, you see, that speed is precisely where EAs have a huge edge. Their ability to execute trades almost instantaneously, that's something no human trader can really match. These systems are constantly monitoring the market, looking for those very short-lived opportunities.
Okay, so how do these scalping EAs actually find those tiny windows, those moments where they can jump in and out for a quick profit?
They rely heavily on technical indicators. You can think of these like signposts based on price and volume data.
Hmm.
Examples would be things like moving averages, which, smooth out price data to show the underlying trend. Or Bollinger Bands, they help identify when a price might be unusually high or low short term. Stochastic oscillators, too, which compare a closing price to its range over a period. These tools help the EA spot very short-term patterns and potential entry and exit points. The idea is make a tiny profit on each trade, but maybe do it hundreds, maybe even thousands of times a day, so those little gains can potentially add up.
Hmm. Okay. That sounds like it could, yeah, generate significant returns if it works. But with so many trades happening so fast, what are the real risks involved? Seems like there must be some.
Oh, absolutely. That's a crucial point. With scalping, very tight risk management isn't just important, it's absolutely essential. Because the profit on each individual trade is so small, even a relatively minor loss can quickly wipe out a whole bunch of gains if you're not extremely careful. So strict stop-loss orders, those are automatic instructions to close a losing trade if it moves against you by a set amount, and really careful position sizing, which is about controlling how much capital you risk on one trade. They're critical, absolute critical to avoid, significant drawdowns, big hits to your account balance.
Okay, got it. So the key with scalping is speed, tiny profits, and super tight control over losses. Makes sense. Now let's maybe switch gears and talk about something that sounds a bit more, I don't know, long-term trend following. What's the fundamental idea here?
Right. Trend following is, yeah, a much longer term strategy. Instead of trying to profit from those tiny, rapid fluctuations, the main goal here is to identify significant, sustained movements in the market, upward or downward trends, and then to ride those trends for as long as they seem to continue.
So these EAs aren't really worried about the second-to-second price changes we talked about with scalping.
Not really, no. Trend following EAs use different kinds of indicators, ones that look at price action over longer periods. These might include, say, longer-term moving averages or the average directional index, the ADX, that helps gauge how strong a trend is, or MACD, that's another popular one that helps identify both the direction and the momentum of a trend. These tools help the EA figure out the overall direction the market is heading. So once a trend is identified, like maybe a stock price has been consistently rising for weeks or months, the EA will open a position in that direction and just hold on to it, trying to profit from that whole sustained move.
That definitely sounds simpler, at least in concept, than trying to catch all those fleeting scalps.
And in some ways it is. One of the big advantages often cited for trend following is its inherent simplicity. You're essentially trying to align yourself with the dominant market direction and sort of ignore the short-term volatility, which is kind of like the daily noise, right? Plus, because you're not trading nearly as frequently, you typically have lower transaction costs, the broker fees, and potentially less slippage too. That's the difference between the price you expect and the price you actually get filled at.
Yeah, that makes sense. Lower frequency, lower costs. But what happens when the market isn't really going anywhere specific? Like, what if it's just moving sideways or kind of bouncing around without a clear trend?
Yeah. That's exactly where the main challenge for trend following strategies comes in. They can really struggle in sideways or, choppy market conditions because there isn't a clear, sustained trend to actually capitalize on. During those times, a trend-following EA might just generate a series of small losses as it keeps trying to find a trend that just doesn't quite take off. So just like with scalping, actually, robust risk management is still absolutely crucial. You need it to protect against potential losses during those trendless periods.
Okay. So we've got these two very different styles. Scalping for the quick, small gains, maybe in volatile times, and trend following trying to catch the bigger, longer moves. But the source material you mentioned earlier, it suggests something even more sophisticated, like the idea of combining these two.
Exactly. The text points out that many modern automated trading systems, and it mentions those used by a company called Faida Ventures Ltd. Specifically, are increasingly integrating both scalping and trend following strategies into a single sort of adaptable system.
Hmm. That sounds like it could potentially offer, the best of both worlds, at least in theory. How does a combined system like that actually operate?
Well, the core idea is to have an EA that can intelligently adapt its trading strategy based on what the market is actually doing right now. So, for instance, if the market is seeing high volatility but doesn't have a clear overall direction, the system might switch into using scalping strategies, trying to grab those short-term swings. But then, if a strong, sustained trend starts to emerge, that same EA could then automatically shift gears, switch over to a trend-following approach to try and ride that momentum for as long as it lasts.
So it's almost like the EA is constantly analyzing the market's behavior, its personality, and then picking the best tool for the job in real time.
Precisely. Yeah, that's a good way to put it. This kind of hybrid approach, um, it has the potential to maximize gains by letting the system be active, hopefully profitable in different kinds of market environments, while also maybe mitigating some of the risks you'd face if you were relying solely on just one strategy. You know,
Mhm.
the system isn't totally dependent on either constant chop or long, smooth trends.
That sounds incredibly complex, though, from a programming perspective. I mean, how do you make sure the system knows exactly when and how to make that switch effectively?
Yeah, that's the tricky part. It requires very careful and sophisticated calibration of the underlying algorithms. The system needs really clearly defined rules and parameters for identifying different market conditions, like measuring volatility levels or the strength of a trend, and for making that transition between scalping and trend following modes smoothly and efficiently. And as the source material really emphasizes, continuous monitoring and adjustment of these parameters are absolutely key. You have to ensure that robust risk management stays top priority no matter which strategy the EA is currently using.
Right. So for a retail investor, someone like you listening, this kind of dynamic approach could potentially offer a way to benefit from both those quicker, smaller profits when the market's choppy, and also those larger, more substantial gains when clear trends develop, hopefully leading to, better overall financial growth over time.
That's the fundamental concept, yeah.
Right.
Now, maybe we should quickly recap some of the key takeaways from our chat and the info in the source.
Sounds good. So, we've learned that scalping is all about trying to grab those rapid, small profits. It leverages the speed of automated systems, especially in volatile markets, but it absolutely demands extremely tight risk management.
Hmm.
Trend following, on the other hand, that's more of a longer-term approach. It aims to capitalize on significant market momentum. It can be simpler in some ways, but it needs to navigate those periods when the market isn't really trending clearly.
Exactly. And importantly, these automated trading systems, whether they focus on scalping, trend following, or like we discussed, a combination, they offer some key advantages, particularly in terms of, well, speed of execution, precision in following the rules, and the ability to consistently implement strong risk management protocols, which, let's face it, can be challenging for human traders to do with the same discipline all the time.
Yeah, very true. And ultimately, understanding these different strategies, as our source points out, is really crucial for you, the listener, to make informed decisions about your own trading and thinking about how your activities align with your longer term financial goals. Now, it's really important we mention the disclaimer that was in the source material. This information is purely for educational purposes. It should definitely not be taken as financial advice. You should always conduct your own thorough research and ideally consult with a qualified financial advisor before making any investment decisions.
Absolutely crucial. And just to reiterate, the information we've been discussing today comes from that document, Scalping versus Trend Following, Optimizing Your Trading Strategy with EAs.txt, which was provided by Faida Ventures Ltd. You can find out more about them on their YouTube channel. That's youtube.com at Faida Ventures, and also on their Facebook page at facebook.com/Faida Ventures.
Right. And if you're interested in exploring these topics further online, maybe doing some digging yourself, the source also provided a whole list of relevant hashtags. Let me see. Hashtag managed accounts, hashtag automated trading, hashtag trading robots, hashtag forex trading, hashtag algo trading, hashtag retail investing, hashtag investment strategy, hashtag Fed Ventures, hashtag financial growth, hashtag wealth management, hashtag tech trading, hashtag trading innovation, hashtag risk management, hashtag financial freedom.
Indeed, quite a list.
So, as you're kind of processing all of this, here's maybe a final thought for you to chew on. Given the potential we talked about for these adaptable hybrid EE systems, the ones that adjust based on market conditions, what kind of future innovations might we actually see in automated trading? Innovations that could further refine risk management and maybe profit generation, even in the most, unpredictable and rapidly changing market environments. It's definitely something interesting to think about. Thanks for taking this deep dive with us today, and we hope these insights have given you some valuable food for thought as you consider the ever evolving world of automated trading and different investment strategies.